Alright, here's what just happened, and why it matters way more than it looks. Recent reports from Bloomberg and Reuters reveal something pretty significant. Iran has moved beyond just threatening the Strait of Hormuz. No, they're now actively controlling access. And get this, in some cases, they're charging ships significant amounts. We're talking up to around $2 million for what they call safe passage. At the same time, Iranian officials have stated that non-hostile ships can pass, but only if they coordinate directly with Tehran. Vessels linked to adversaries, though, they might be restricted. This isn't just a fee, folks. This is a fundamental shift from threat to control. Now, to truly grasp why this matters, you need to understand what the Strait of Hormuz actually is. Roughly 20% of the world's oil supply, that's about 20 million barrels per day, flows right through this narrow channel. And a huge share of global liquefied natural gas? Yeah, that passes through it too. Countries like China, India, Japan, and South Korea, they depend heavily on this route. So when anything happens here, it doesn't stay local. It moves directly into global prices, inflation, and markets. Like that. Iran's move, by the way, is not random. Oh no. There are very clear incentives behind it. First up, revenue. So why is Iran doing this? Let's break down their strategy. First up, pure cash. Under immense pressure from sanctions and war, Iran desperately needs ways to generate income. And turning a vital global shipping route into their toll gate, that creates a brand new income stream, directly tied to global energy demand. Second reason, it's about leverage, but without full-blown war. A total blockade, well, that would almost certainly trigger a direct military response, but selective control, that's far more flexible. They can allow some ships through, delay others, even block specific countries entirely, all while still claiming they're just regulating security, not actually shutting down the strait. Third, and this is fascinating, geopolitical sorting. We're already seeing signs that ships linked to certain countries, especially major Asian buyers like China, might be treated very differently than those tied to Western allies. This means access itself transforms into a political tool. You don't just pay with money anymore, you pay with alignment. Fourth, strategic signaling. Iran is showing the world, hey, we can influence not just regional security, but global energy, shipping, inflation, and diplomacy, all at the same time. This isn't just regional leverage, this is leverage at a systemic level. And what's already happened as a direct result? Shipping costs are already rising, sharply. So one of the world's absolute huge shipping companies, Hapag-Lloyd, they've actually reported that they're absorbing between $40 and $50 million per week in additional costs, all because of this crisis. And what does that include? Well, things like fuel, insurance, rerouting their ships, and of course, all those delays. Now these costs, they don't just disappear. Oh no, they get passed on, right? Through the entire global economy. But it's not just about money either. There are also very real physical disruptions happening. Think about this. Around 20,000 seafarers on nearly 2,000 commercial ships have been directly affected. Some are even effectively stranded in the region. I mean, that really tells you this isn't just some pricing story. This is a real-world, massive logistics disruption. Insurance costs are, of course, skyrocketing. Shipping routes? They're being totally reconsidered. And some ships are just avoiding the strait entirely. Others, they're just waiting. And all of that, folks, it adds time. And what does time always add? Cost. Every single time. Now let's shift gears to the energy side. The impact there? It's been immediate. Oil prices have already surged, pushing Brent crude at one point towards the mid-100s.
It pulled back slightly on some ceasefire hopes, but
recent levels have still been hovering around that $100 per barrel mark for Brent. Larry Fink, the CEO of BlackRock, he actually warned that if oil reaches $150, it could absolutely push the entire global economy into a recession. That's a big deal. And guess what? This isn't just about oil either. This isn't just about oil, folks. This stuff spreads into jet fuel, fertilizers, petrochemicals, and all sorts of manufacturing inputs. Airlines are already sounding the alarm, warning that ticket prices could skyrocket if fuel costs stay this high. And over in Europe, executives are warning about possible fuel shortages if this disruption disruption keeps up. Meanwhile, in Asia, governments are bracing for broader economic stress, all because of their heavy dependence on Middle Eastern energy. But it's not just economics, is it? There's also a serious political and military layer building around all of this. At the United Nations, Bahrain has actually proposed allowing all necessary means to keep this vital strait open. But guess what? China and Russia are opposing that language. And that means, folks, there's no clear global consensus on how to respond here. This division, of course, gives Iran even more room to operate. Now, at the same time, Western powers are acutely aware that even securing shipping lanes isn't easy. Look at the Red Sea. Despite spending more than $1 billion on military operations, attacks there still disrupted traffic. And here's the kicker. Iran is far stronger, closer, and more capable in the Strait of Hormuz than those groups operating in the Red Sea ever were. That makes any attempt to forcibly secure this route incredibly complex, and frankly, far more dangerous. So that $2 million fee, that's not the real cost. The real cost is the risk. Think about it. The risk of delays, the risk of attacks, skyrocketing insurance costs, even supply disruptions. All those risks, they become a premium, a cost added to everything, from the price of oil to your airline tickets, even the consumer goods you buy. And for financial markets, this creates a very specific pattern. Energy companies, they tend to benefit first, right? Because higher oil prices mean their revenues just go up. Defense companies might also see a boost if things escalate further and governments start ramping up military spending. Oh, and don't forget, domestic energy sources, or any sources not tied to the Strait of Hormuz, suddenly look a lot more attractive. But on the flip side, airlines, shipping companies, any industry that relies heavily on fuel or petrochemicals, they're suddenly under huge pressure. And we as consumers, we feel it too. Because higher energy prices, they're basically a global tax on everyone. For the broader stock market, the overall effect is volatility, pure and simple. Markets stop caring as much about company fundamentals and start reacting way more to every geopolitical headline. A simple ceasefire rumor can send stocks soaring and oil plummeting in a single day. And a new escalation, that can reverse everything just as quickly. So for the average investor, the key isn't to focus on the cost itself, but on what that cost represents. This, my friends, is a fundamental repricing of energy security risk. This is a big deal, right? Because it hits inflation expectations, interest rate expectations, and corporate margins all at once. That's a triple whammy. If this disruption keeps going, the chain reaction is super clear. Higher energy costs, they mean higher inflation, and higher inflation limits how much central banks can actually cut rates. That, in turn, puts serious pressure on economic growth and all those valuation-sensitive assets out there. Now, at the same time, you'll see certain sectors just absolutely outperform, while others, well, they really struggle. So looking ahead, what are the realistic paths? There are three. Path number one, de-escalation. If diplomacy somehow succeeds, oil prices could fall really quickly, and some of that risk premium would just unwind. Path number two, and this is probably the most likely in the near term, a controlled selective system. Imagine Iran allowing some ships through, blocking others, and then charging for access. Clever, right? That keeps the pressure on without triggering a full-scale conflict. And finally, path number three, escalation. A coordinated attempt to reopen the strait by force. But honestly, given all the challenges we've seen in the Red Sea and the current lack of global consensus, that would be incredibly risky, super costly, and just so uncertain. The deeper implication here, though, goes way beyond just this moment. This is a prime example of what we could call infrastructure leverage. Instead of destroying a system outright, you just control it. You price access to it. Boom, you decide who gets to use it and who doesn't, and use that control to influence global economics and politics at the very same time. That completely shifts the balance of power. It encourages countries to build alternative routes, new pipelines. It pushes buyers to diversify their energy sources. It creates incentives for entirely new alliances. And it's a stark reminder to markets that a single choke point can still move the entire global economy. So the headline isn't really about a $2 million fee. No, the real story is that one of the most important arteries of the global economy is being turned, even temporarily, into a controlled gateway. And that changes everything. How energy flows, how markets price risk, and how power is exercised in the modern world. Thanks for watching.